Welcome to Yellow Tunnel and TradeSpoon and Tradier Hub. We're doing simultaneous broadcasts on many channels, so I'm really excited to have everybody join today. And today we're going to talk about live trading room. We're also going to discuss earnings season that starts next Friday. JP Morgan is kicking off the earnings season, how to take advantage of the current volatility. We have unemployment data tomorrow. We have different Fed speakers this week and next week that creates volatility in the market. And more importantly, we have CPI and PPI data Wednesday and Thursday, right before the earnings season starts, and Delta Airline earnings, I think, Wednesday or Thursday. So that creates opportunity in the market, creates volatility in the market. So how do we take advantage of these asymmetrical risk versus reward, right? This is the time of option market makers talk about convexity, right? Convexity, and that's what we're going to talk about. For those of you who are new, welcome. Glad you guys are able to make it. Fred, good afternoon. Martin. Fred, what a sell-off. I will talk about sell-off too. Thank you for participating. The difference, good afternoon, Joseph. Thank you for being here. The difference between TradeSpoon, Yellow Tunnel, TradeSpoon's services is that my background is technology. I've been a CTO of several publicly traded companies. Once they went public, I decided I'm going to manage my own money, build a team of financial engineers that are building models, looking for opportunities in the market, and I start trading them. And I've been doing that for over 10 years. And now I'm exposing the research, the AI signals, and the live trading room, which you're part of as part of our service. So that's my background. I am going to go through specific trade ideas and trade setups. Some of them are more complicated, like butterflies or counters. Some of them are straightforward, like stock. So it's important to understand the risk associated with trading stock or options. I encourage you to visit the link on your screen, optionscreening.com, so you can understand the risk associated with trading stock or options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education and information purposes only. Let's see if there's any questions from Tradier Hub. Looks good, clean. I didn't mess anything up today. Bob present, thank you. All right, so let's excuse me. Let's talk about market first. So I think volatility you can see is picking up a little bit as we are reacting to macro and microeconomic data. And usually, if it's a strong data, good data, like manufacturing data, above 50, everybody's looking at the manufacturing PMI, services PMI. That is usually a good leading indicator that the economy will continue to move forward, right, and expand, which is good for the stocks. And why can I load this? Okay. Okay, sorry about that. So let's look at spiders. I mean, Fred already noticed that there's some pullback happening. So I think we have different. Let's look at 1 hour. So different speakers, Fed speakers from different regions, are basically taking a look at the economy and the state of the economy of their regions, right? Chicago Fed President Goldsby, and then Cleveland Fed, Minneapolis Fed. So there are, as they speak, right? So this is 11:45 Central, so from 11 to 1, and this is when the sell-off started, right? Because I think the comments were that, economy is doing great. Why do we need to lower interest rates? Maybe interest rates cuts are off the table, right? Maybe they're off the table. Similar message we had last year, right? Last year, everybody thought we're going to have at least 3 rate cuts. And then as we approach close to the summer, at some point, everybody realized, well, there are no rate cuts. Again, I think situation is a little bit different. At this time in November, December, Powell committed to 3 rate cuts. He reiterated the rate cuts as early as Monday. But obviously, there is more than one opinion in the Fed committee. And since market is overbought and extremely vulnerable, any messaging indicating that interest rates are higher for longer, well, that kind of puts in danger soft landing and potential dislocation in the market. So on that comment, spiders did break lower. Let's zoom out to 1 hour, 1 day. So again, it broke through. So it's this week lows, right? Maybe we have to go back. So it's April lows. You have to go back to March 20th, and the support was 517. So we're trading at 515. Let's turn our attention to our friends at Tradier who build dealer exposure. Right? We talked about dealer exposure. And let's look at the positioning in spiders. As we approach an unemployment data tomorrow, right, which also could either cause the market to rally back up or the sell-off to accelerate. So I'm looking at, even if you're not an option trader, even if you're a stock trader, you need to know the trend and you need to know support and resistance level, right? I mean, unless you're a long-term investor that holds the position, Warren Buffett, value investor, you don't really care about short-term fluctuations. Support and resistance levels, they do matter. So looking at the support for tomorrow, relatively large position at 510, right? You don't really have anything below that. So we did break from this week low and last week low. So it looks like that opens the door to 510. 510 is pretty well supported, at least into the unemployment data tomorrow. So probably unless unemployment data is a lot worse than everybody expects, bulls and bears should meet at 510, and I think at least 510 levels should hold going into unemployment data tomorrow. If you zoom out and look at the April 19th expiration and May 17th, so now I'm looking at the monthly expiration and I need to zoom out. 500, so very much larger than a pretty large position. If you look at the SPX contracts, if you look at the spiders contracts, very large position of put buying at 500 level. So there's some at 510 as we noticed earlier, right? 510, but it's significantly smaller position, maybe half the size. So I think 510 is the next level of support, right? Assuming that we're going to close towards the bottom of the range. The next level is 510, right? The next level is 510, which is this line. We tried to break to this level, then it was a support, and that's where we position. And it matches close to the 50-day moving average, right? Which more often than not holds. If you zoom out, a much bigger position is at 500. So this is support number 1, and this is support number 2. Right, assuming we're going to close at these levels, 515, 514, we'll see if the sell-off accelerates. Interesting that 10-year yield is also dropping, right? 10-year yield is dropping. In theory, yield should go up, right? And spiders should go down. But yield is down, and I think dollar is down. So I think these are just short-term repositioning as people are concerned about unemployment data and CPI data. But at least for now, 10-year is dropping, which is positive, and the divergence is that spiders are also dropping. Usually that indication of people that, at least today, they're not concerned about inflation, they're concerned about recession. Because if they were concerned about inflation, then the 10-year yield would go up. But since the yield is dropping and TLT is up, right, and the QQQ is down, that usually people are worried about recession. And we've seen these divergences. Usually they're short-lived. They have been short-lived. The only divergence that does not make more sense and kind of persisted for since the beginning of the year is silver and gold. Right, silver, gold, yield is down, yield is up. They're consistently moving up, kind of in this parabolic shaped move with extreme volumes. That is the narrative that there's too much debt, inflation is higher than expected, and people are concerned with 70s, 80s type of prolonged inflation. That would be a logical explanation for gold and silver. The only thing that doesn't make sense, well, why is spiders at all-time high, right, and continues to grind higher? That needs to be reconciled. So as we are approaching, so we talked about 10-year yield, right? Drop in dollar also pull back, right? That's also bullish. We have retesting 200-day moving average. So dollar is down, 10-year yield is down below very important level. Right, it kind of broke above the year-to-date high and now trading below. And this is a key support level that spans over multiple years, actually. We've seen it in 23, we've seen it in 22. This is an important line in Ascent where people are nervous if it gets too much higher than, this line, then people get nervous. And if it drops below, then they're less nervous. But nonetheless, VIX is up to 16, so people are concerned. Pretty sharp rise. We were at year-to-date high. And we were at 18, but this is VIX expiration. But in terms of year-to-date high, we're at that level. So definitely more people are concerned, and you have a broad-based pullback across all asset classes, right? Whether it's interest-sensitive sectors or growth sectors pulling back. But market is overbought, and we'll see how long it will last. Home builders continue to underperform, metals and miners, big jump in VIX. Dollar is stable, that's good. Healthcare is down, consumer discretionary, retail, transportation, QQQ, semis, conductor, value stocks, Dow Jones, Excel, consumer staples are down, banks are down 80 basis points, regional banks are doing good, actually flat, surprisingly. And airlines are down, utilities down, small caps down. Okay, so across all asset classes, we're down. So let's talk about how do you structure your trade. All right, if you're looking for this outsized move, right? If the inflation is still an issue, if Fed is going to still reduce their balance sheet and not lower interest rates, and earnings season could be volatile, right? How do you take advantage of these market conditions? Well, one is earnings, right? Event-driven volatility. And we've seen this today. We did it with Play, right? Dave & Buster's, right? So we have Dave & Buster's as much as 20% up after the earnings. I mean, it looks like it gave up all of its gains, but you have up to 20% move in Dave & Buster's. And today I was trading Levi Strauss, right? Levi. Also up, were at some point up as much as 20%, right? So the theme of the earnings season is that if you read the Nassim Taleb, right? If you follow my blog, we actually met yesterday with my friends, and we have a book club, right? And we talked about, anti-fragility, right? The book by Nassim Taleb, and he talks about convexity, right? He talks about convexity and a lot of mathematical formulas and asymmetrical risk versus reward. So how do you look for these asymmetrical returns? Basically saying that, if an event should occur only 1% of the time, well, in this period of time, it happens 10% of the time. And that's kind of the reflection of earnings, right? Everybody's nervous. And if you deliver strong earnings, like we've seen with Dell, right? You have AI theme, then the stock moves, vertically higher, 2 standard deviation, interestingly still at that strike price, and or microns, right? You have, microns moving 2-3 standard deviations. So how do you take advantage of those opportunities? And as we approach in JP Morgan, obviously JP Morgan is not a meme stock, nor is it has a theme of AI, right? But it is a very strong bank. It had delivered very strong earnings. I assume there will be volatility in the JP Morgan, right? And what the interesting part, if you look at the, let's say, Dave & Buster's today, right? Dave & Buster's, not the most liquid name. It doesn't have weekly options. It's a large bid and ask spread, but nonetheless, to demonstrate the point, you actually do see that. Well, that was, what did I do? Yeah. So you have a pretty large position at 55, positive Vanna. That means people were concerned that Dave & Buster's could drop to 55 if they delivered negative earnings. Or on the upside, you do have a pretty large position at between 70 and 75, right? Between 70 and 75 level, which implied, 10 to 15% move in play. And if you look at what actually happened to play, it did move toward, I think it was as high as 70, after our session, as high as 72. Obviously, because the market is pulling back today, the sell-off is accelerating, so it didn't stay at 72, but it did reach 70 and 75 strikes. So these levels, where you see large open interest at the certain strikes, they do act as magnets or repellents. In example of Dell, it's been almost a month, and it's still staying at the level where there was a lot of open interest, right? So how do you trade in this specific example? So through earnings power trader, I did trade butterfly, right? So I did the butterfly. And this is the idea of butterfly is kind of what Nassim Taleb talks about, in anti-fragility and asymmetrical returns. Anti-fragility book. So that's the book. Okay, this is Wikipedia. So he talks about skin in the game, barbell strategy, green lumber problem. Where's asymmetrical return? Or convexity. Response. Convex. Okay, but so the idea is, I can't find the exact definition, but he does talk about these where you have a barbell strategy, right? He talks about barbell strategy, basically where a majority of your money, you're not taking a lot of risk, right? But there's a small amount of your portfolio where you're taking a lot of risk, right? And you're looking for outsized returns. And that's an example of using butterfly or condors. The example of butterfly, if you do look at the butterfly, the profit and loss looks like this, right? Where this is a middle strike, you sell 2 times the middle strike, and then you buy 1. And you want the maximum return if the price gravitates toward the strikes and kind of stays there. So in play, it was 70 between 70 and 75, right? So I chose 70, 75, 80 spread. The stock did move to 70. So when you have that directional move and you use butterflies as a directional trade, you can put on a trade in relatively small amount of capital, right? In this example, it was 48 cents and 60 cents, right? So I put it for $1.08. It didn't stay at 70, right? If it moved too close to 75, this would be a bigger return, but it did move close to 70, close to that first peak in the high open interest, which it could gravitate to, and I was able to close the spread for $1.40, right? And today actually closed the rest for 20 cents. So in this example, I made maybe 10% return, 10% return on the money. But if it did get close, if it got close, then it would be a higher return. An example today in Levi, the return was much bigger because I selected 21, 22, 23 strike, and it got right to 22. And same thing, I basically break butterflies two spreads, right? In a 70, 75, 80 call spread, you have a debit call spread, bullish, your bullish opinion that it will move at least 15 to 20%, but it's not going to move beyond 80. It's not going to move, 5 standard deviation moves. Or where there is no large supply and demand, right? There is some demand at 80, but it kind of drops off, right? Majority of the demand is 70 and 75. So if you assume that it's not going to go beyond 80, then that's your strategy where you can risk $1. And in this example, maximum gain could have been, $4. So looking at JP Morgan, as JP Morgan is set to announce earnings on Friday, right? On Friday, let's see how people are positioning, how excited they are about banks, right? So this is April, right? So in April, position pretty large calls, about 210, right? So 210, there's a pretty large position at 210, implying that potentially 5% move in JP Morgan, which is reasonable expectation. That JP Morgan, if they deliver another strong earnings, usually they move about 4 to 5%. So you can look at the implied volatility, you can look at the historical volatility, you can look at the open interest, and it will tell you that majority of the people are actually think that high probability it can reach 210. Actually, there's some selling of the puts at 190 puts. Some people don't think it's going to drop below 190, so they're selling the puts to do the risk reversal. Not in this case, it's not risk reversal, but they sell and put and they buy and they sell and call. So maybe think of it as a strangle, right? They sell both extremes. Selling 210 call, selling 190 put. And in terms of if they don't deliver and they miss earnings, the key support is actually 180. I do see a lot of support at 180, very little at 185, but majority is at 180, which would imply maybe 8% move to the downside. So you have 210, right? You have 210, 14, that's 14% to the upside, and 180, $14 to the downside. So that's about 6 to 7% move. So it's going to be volatile, right? I think, usually I don't place this trades ahead of time, but that would be my setup to do either a long butterfly if I see a clear picture where the strike price is, right? If it's 210, okay, so that's my short strike. If it's going to stay at 210 and probably not gravitate to over 220 anytime soon. There is a very large open interest in May. Somebody's selling aggressively May 220 calls. So it could get there, but that's May, right? So which is still far away. More likely scenario, it's 210. So you can sell a straddle, buy long butterfly, let's say 200. 200 is too close, but 205, maybe 215 and 225. Either $10 strike difference or $5 strike difference. Depends on how much capital you want to risk. And on the downside, 180, right? You can buy maybe 185 put, 180, and 175. Or you can do 185, 175, 165 butterfly. And as long as JP Morgan does move, 4 to 5%, this is where you could, or more, right? Navigates toward the middle strike. That's where you're going to maximize your gains, right? So butterflies, condors, these are the strategies where you could have these outsized returns. All right, any questions on Tradier Hub or on our platform? Joseph will have to fill the gap 500, 505. It looks like that. Well, first 510, I think. So question is on spiders. Where are we trading now? Where's the spiders? 513. So spiders continue to drop. The first line of defense is tomorrow is the 510 level, right? So we're basically, within 0.5% of 510. It is a much bigger position at 500. So something has to happen for spiders to drop below 500, below 50-day moving average. It could be worse than expected unemployment data. It could be, what else could it be? CPI and PPI data, right? So it's definitely possible. It's a pretty sharp pullback, above average volume maybe. It did break this uptrend, and in terms of, I don't know if there's a gap, 504. Yeah, but 510 is your next level. There's really no support till 510. So tomorrow, obviously, we could be at 50-day moving average, 505, 510, right? I think 510 should hold. Or we could revisit the highs. So we'll see where exactly we're going to go to. Fred, thank you for, yes. So Fred and Bob and everybody else always have great ideas. That's why it's important to be part of the community. We're sharing ideas. This is not a one-way show. We do have very valuable feedback from our live subscribers. One of the positions is QQQ. And I think this is also kind of going back to this anti-fragile barbell strategy. Barbell strategy basically says that majority of your portfolio, especially if you're managing significant portion of your savings, right? You don't want to take a lot of risk on your entire portfolio, right? So you have days where market is down 1-2%. You want to be able to have some kind of hedging in your portfolio. So we did, Fred suggested to buy a put spread. So yes, these are the days where insurance, if you have insurance and the house, is being flooded or in danger, that's good to have, right? And we do see that QQQ actually retesting 50-day moving average. You might want to close that QQQ put spread if you think that unemployment data is going to be better than expected. Let's see, what's the value? For some reason, it's not worth more money, which is interesting. Oh, no, it is more. Okay. So it's trading about 580 now, 570. Last sale, 580. 60 cents. Yeah, so it's up 15%. So you can, it's a 50-day moving average. You can close it if you want to take profit, or if you want to continue to hedge your exposure to the market due to CPI and PPI data. We can look at QQQ where the next positioning is. So today, tomorrow, 436. Not much support till 430. So assuming unemployment data, even if it comes in a little worse than expected, right? Nothing really strong about the data. We could quickly drop to 430, right? So it looks like there's small support at 430. And going into the next week, let's see. Yeah, April 19th. Yeah, 430. So April expiration, very large position at 430. So based on the positioning and based on the supply and demand, it looks like the 50-day moving average should hold. You might squeeze another 1%, Monday, Tuesday. But for now, at least, very strong support 430. If we don't hold the 430, then we talked about the gap, right? The gap, 422. But more often than not, it does hold the 50-day moving average. So we'll see if that's going to stay the case. Thank you, Fred, for the suggestion. 10 point QQQ. Yeah, QQQ, big reversal again. When speakers, FOMC members talk about that, but potentially there's no interest rate cuts, well, everybody is scared, right? It has to come from Powell to make any more meaningful, longer-term lasting effect. where on Monday he's still committed to 2 to 3 rate cuts. So this is just temporary kind of adjustment to the market conditions. Meta, Tesla, and defense stocks positive. Okay, let's review the caps. Thank you for letting me know. Let's review. All right, so materials looks like giving up some of the recent gains. Europe is under pressure. Apple is flat. Google is down 2%. Right? So it looks like it made all-time highs and now reversing. Tesla is turning positive, but it's been oversold. And Meta is actually positive, right? So you have Meta and Tesla. Well, Tesla got beat up, so there's some positive news because it was as high as 177 today on Tesla, and Netflix is down, Meta is up. Meta is up 1.5%. All right. ARK Innovation significantly down. Bitcoin is up, so you do have a rally in Bitcoin, which is positive. Micron down 3%, Qualcomm is down 2%. Deere is flat, holding on to its gains. And that's about it. All right, any other questions? Thank you, Bob. And GE is always up. General Electric has its own. Has its own. I mean, it did give up most of the gains from today, but nonetheless, it's still positive. All right. So Meta is up, GE is up. It's still, there's some signs. I think this is just a short-term adjustment, and triggered by comments from the Fed speakers. Unemployment data, CPI. Unemployment data, I assume, is not going to be a big surprise. I think it's going to be kind of a status quo. I mean, market is oversold, right? QQQ is at 50-day moving average. It could spark a rebound. Maybe now that I do have a H position, and QQQ is at 50-day moving average, 430. I mean, we could get 430. I mean, I'm inclined to maybe close the spread right now, take the profit, and then if we do break through the 430, right? I do know that if we do break through 430, which has a pretty large position, there's a lot of position at 425. So 435, 425, pretty well positioned, right? It's pretty well positioned. So I don't think there's going to be a lot of momentum to the downside. So, I mean, obviously the gap, right? So my inclination is close the spread. And if it does break below 433, below this line, then yes, the gap is probably going to be filled. So maybe I'll put that trade again and see if I can drive it to 420. So I'm going to do that trade. This was a good hedge. Good example of the hedge. And I do have a Sage. So in case it continues to go lower, it's not like I close all of my spreads. So let's see. Can I do it for 580? All right, and I should be on the NASDAQ show tomorrow, which is exciting. Okay, so QQQ bought at 525, 2 days ago, trying to close for 580. It's a little bit over 10% move. Let's see, SMH. So it looks like semiconductors are dropping, pulling back. QQQ. And spiders. So QQQ is at 50-day moving average. 50-day moving average has been a strong support for a lot of indexes. And spiders is not that far away from 50-day moving average, right? Maybe 1%. So hold on, I'm not supposed to do this. Okay, so let me look at my personal account. Let's review that. Yeah, it looks like I just got filled. Okay, so I'm out of the QQQ put spread. I do have SH in case market, negative earnings surprise or negative CPI data, but that would be one way to hedge your portfolio. If you don't have any hedges and you're concerned that these support level 50-day moving average will not hold, then you leave it on. But, more often than not, 50-day moving average does hold. Let's look at. All right, so let's look at ExxonMobil. Let's see which levels are well supported, which not. ExxonMobil is one of the. So I do have energy exposure, ExxonMobil. So ExxonMobil looks like it's still positive. XLE energy is slightly down, but nothing major. Let's look at NVO. So NVO hit the 50-day moving average. That's been a pretty good support. Let's see how much position is in NVO. So there's not a lot of put buying up until 113 strike. But it has reached 123. So I do cover calls in my personal account. So maybe, this is an example where either you close the short call or maybe you want to buy the stock. So let's see if we want to do that. Okay. And in my personal, so I'll buy a stock, right? I've been trading around NVO position, right? You can look at the profit accelerator. So I've been trading around this position for quite some time. Assuming QQQ holds the position, I sold at 130. I did buy at 126.79, 124.44. Okay, so I'm going to buy more shares. At 124.09. The question is, how many shares do you buy? So we got to look at where's the support. Well, QQQ is at 50-day moving average, so that's one support. But in NVO, there's really no support up until 113, 115 level. So if the 50-day moving average does not hold, right, and we're still pretty far from this uptrend. I mean, you do have support at 120, right, which is not that far. But if the 120 doesn't hold, you could drop to that uptrend, which would be around 113, the gap 115 level. So same thing. If the stock, let's say, drops another $10, you don't want to be down more than $250 on $10,000 portfolio, right? So on $10,000 portfolio, I propose not to risk more than $250, right, and have both long and short positions. So if you're risking it's a volatile stock, it could move $10, $250. So your whole position should be maybe 25 shares, right? 10 times 25 is 250. So if you already have 10 shares, I wouldn't buy. But if you have 5 shares, right, if you were trimming the position the way I was doing them, then maybe this is a good time to consider buying back NVO. Questions? Let's break down. Micron is still doing well, close 70% of my put spread, keeping the rest. Okay, thank you, Fred. We'll add to my watch list. Spot is breaking down, reopening Micron, selling 120 put. Reopening the put. All right, Fred is, I mean, you take advantage of the volatility, right? If you think that QQQ will hold or, it's close to the bottom, right? Nothing really has changed unless I missed some news. Maybe you guys can tell me. But assuming this is just Fed speaking about potentially not lowering interest rate, well, I don't think that's a new news, right? This is not something that we haven't heard before. So people are taking profit, assuming this holds, then this is the time to start thinking about buying. All right. I mean, adding to your positions. Let's see what else. Right, some of the other positions we're managing. Let's see. EWJ. So same thing, it's approaching 50-day moving average, right? So it's approaching strong support. For now, no changes. IWM. Retesting, recent lows. Not that far from 50-day moving average. So that's also interesting. SMH, we talked about SMH. I mean, it closed the gap. Next level would be 50-day moving average around 211. How's NVIDIA doing? NVIDIA is down 2.5%. So NVIDIA is approaching key support level. And JP Morgan. It's SMH position. All right. Those are the main positions. Let's see. Any questions? Qualcomm down 3%. So I did buy Qualcomm. It is down. Basically reversed all of the changes from yesterday. I would watch NVIDIA. Right, so tomorrow is important, right? If NVIDIA breaks below this level, then probably need to get out of Qualcomm because it's going to drop more. I mean, my proposal was to reduce your size going into the Fed decision. So for now, if you're not down $250 on the $10,000 account, I mean, I would wait. I mean, it's still a strong uptrend. It's above 50-day moving average. It's above March lows, right? It's above March lows. So as long as it's above 163, I think this is a good support level. But again, it depends where you selected your stop level, right? If you got stopped out on Qualcomm, if you're already down more than $250, I would exit out position because you don't really know how far the market is going to drop. I think I was talking about 167 or 165 support level. So I would watch 167, 165 level, right? That's kind of where it's positioning. Let's see where else is Qualcomm. Plus NVIDIA, plus QQQ is at 50-day moving average. If that 50-day moving average doesn't hold, I mean, then there would be an issue. Let's see. So at least up until this Friday and to the next Friday, 167.5. So 167.5 is pretty well positioned. Is well positioned. I think that's what we were talking about this morning. So the idea was at 167.5, I'm down $100 on $10,000 portfolio. I'm only down 1% of my portfolio, and then I need to decide, right? Is this just a short-term adjustment because the market is overbought and it just needed an excuse to sell off? Then maybe you add. If inflation data is worse than expected, I mean, unemployment data is worse than expected, inflation data is worse than expected, and we're dropping below 167, 165 level, then yes, I would exit the position because that means NVIDIA is going to pull the entire semiconductor sector, right? Because it's been consolidating. It's been consolidating and it's sitting on a very important support level, right? All the way to the beginning of March. So if it doesn't hold that level, it could retest 50-day moving average, right? It could revisit the highs post earnings, which is 800 level. So if it doesn't hold this level, yes, I would probably have to exit from Qualcomm, and we'll see. Let's see what else. Let's look at spiders. Let's look at 1 hour chart and see if maybe we can zoom in. Yeah, so the main support was 516 this week low. So we broke through it pretty decisively. Let's assume we're going to close at these levels. I mean, it's all about tomorrow, right? We're either going to be revisiting the highs, or we're going to, retest 510. For tomorrow, 510 is pretty well positioned. So in theory, we should not break 510. I would use 510 as a buying opportunity tomorrow, assuming that it doesn't just shoot below, right? Usually what I do is we wait 15 minutes, 3 candlesticks, 5 minutes, and then you see if that level holds or not. If it doesn't, obviously, then the next level is 500. But more often than not, 510, you have to go back to almost beginning of March. Right, this would be almost March low. So it's a pretty significant support. All righty then. That's all I have for today. Any other questions? On the, sorry, I'm not supposed to. On the Tradier Hub. Staying with RTX. Thank you, Joseph. All right, guys. Thank you very much. Have a great day. I will see you tomorrow. Oh, today we have 7 p.m. We have a webinar. So we're not done for today. There's another webinar at 7 p.m. Tomorrow's strategy roundtable at 9:30, and then the closing bell. Other than that, thank you very much. On the Tradier Hub, we'll see you next Thursday. And on Yellow Tunnel Tradespoon, I'll see you guys tomorrow. Thank you very much and have a great day.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.